All right. Ultimate wealth is found in wisdom
Let's do it.
alone.
Welcome, everybody. This is actually our third tax threshold retirement plan contribution change webinar, but hopefully we're getting better each time. But I'd like to introduce everybody. So if you haven't met us, I'm Neil, and to my bottom here, I don't know where we're at on the screen, on the Brady Bunch screen, but we have John Cardwell and Robert Wallace and Cam Rondeau. So thank you guys for participating, and hopefully this is valuable. Just as a note, on the bottom of your screen, and you might have to take your mouse and hover over it, you'll see a Q&A tab of two bubbles. So if there's any question throughout this presentation that you want us to go into more depth on, don't hesitate. Shoot us a question and we'll get to it potentially at the end of the discussion here, or even if we're on that slide, we'll hit it up right then. So don't hesitate. So I'll share my screen and we'll get going on this. All right. So threshold. What does threshold mean? It's the magnitude or intensity that must be exceeded for a certain reaction, phenomenon, result, or condition to occur or be manifested. So it comes from thresh, which is to rub, turn, stamp with feet, to knock, to beat, or to strike. So
that sounds unpleasant, Neil.
Yeah, not real pleasant. So today we're going to be going over and describing the level to which you will be beaten, turned, stamped, knocked, and stricken. So remember that the IRS spells theirs. All right, so as we go into this, just first off, we're not tax advisors. So if there's a specific tax question that needs to be answered, we would recommend going to your tax advisor or your CPA to get that question answered. And then this is not meant to be personalized advice. So it's kind of just general categories. We're going to go over a number of different, income categories and things that might apply to business owners and may not apply always to retirees. So we're kind of covering this on a broad basis. But here are some of the things we're going to be going over. In 2023, believe it or not, we're already there. All the income brackets and a number of other brackets went up with inflation. So we're going to be covering exactly what those thresholds are in some cases and how much they went up. We're going to go over the standard deduction, child tax credit, gift and estate tax limits that went up, education credits, other deductions and distributions from education plans and how those changed, tax deadlines briefly, retirement plan contribution limits. We're going to be spending a little bit more time on that since that applies to just about every one of our clients. Social Security threshold, we're going to cover that. A little bit on the FICA and Medicare tax, Medicare premium thresholds. And then we're going to go into a discussion briefly on Secure, what they're calling Secure 2.0, which was about 300 pages inside the omnibus bill, which was 4,000 pages. That was just passed in December. So we're gonna touch on that and the main things that will affect most of our clients.
I just wanted to mention too, we're going to be covering a lot of numbers here, and all the attendees, anybody who wants a copy of these numbers, just email anyone on the Axiom team. We have a nice document that we'll be able to share with them at any time.
Yep, we call it the cheat sheet. So, it's a kind of a quick hit of all that we're going to be going over here. So, and we will send that out to everybody that's participating in the meeting. So as you can see up on the screen now, this just goes over where different tax brackets are at. So, if you're in certain income levels, either single filer or married filing jointly, you're taxed at a certain rate. For the first, it's married filing jointly, the first 22,000 is going to be taxed at a 10% rate. The next 22,000 to 89,450 is going to be taxed at a 12% rate, and then on up to the 22. So the 12 to the 22 is a big deal, something to think about. That's a 10% increase. And then the 24 to 32 bracket, Those are some things to keep in mind, you know, where your income is going to be taxed at. Robert, did you have something you want to go over this in a little more detail? I may have jumped ahead of some things you wanted to cover.
No problem. Well, you've hit the biggest part of it. These tax brackets probably look familiar to a lot of you because these are the same basic tax brackets that we've had for the last few years. The numbers are moving up, so there's more income allowed in each bracket. And as Neil was mentioning, you know, we're looking at these 7 tax brackets in basically 3 buckets. You know, we have the 10 and 12% marginal brackets are very similar. The 22 and 24% marginal brackets are very similar. And then 32, 35, excuse me, 32, 35, and 37%. It's all basically this. It's a very similar higher income bracket in there. And, you know, as opposed to some of the thresholds, some of those harder cliffs that we'll be looking at later on in this presentation, you know, these marginal brackets are more of soft lines. And, you know, that means that each one of those tax brackets from what we're seeing at the top of the page down, the lower the income, those buckets get filled up before the higher income. So it's, we want you, we try not to be afraid of crossing through those margins. We don't want to not earn income that's potential. We just want to be mindful and do what we can to maximize the lower tax brackets as much as we can, utilize them when possible, when appropriate. And the same thing is the same sort of lines are applicable with the capital gains and the qualified dividends that we see at the bottom of the page. 3 buckets in there for the lower tax brackets. It's 0% capital gains rate for income. You know, the lower income brackets, 0% tax rate. 15% for everybody in the middle, and 20% for the high. And this is what for those stocks, those real estate holdings, the pieces that have been held for more than 1 year. They get that special capital gains tax rate, which is usually lower than the marginal tax breaks. Neil, you want to take it from here?
You know, Robert, I had a quick question for you. We're in the state of Oregon. The majority of our clients are in the state of Oregon. Where do those increases take place in this federal income tax bracket graphic here?
Great question. For the most part, just about everybody that we work with is going to be either in the 8.75 or 9.9% tax bracket, and that big threshold, that break, is in the 125 for single, 250 for joint filers. So it's going to be right in the middle there of that 24% federal tax bracket. And
Thanks,
Kim, you
Robert.
had a question? I don't know if I can't.
I was going to
I
suggest. I was just going to suggest if you can point without using your cursor. It's hard to see your little arrow. That's all.
Neil's got the pointer.
Okay.
Anything else we want to touch on here?
Again, what Robert said, you know, this is not something that we should fear crossing. It doesn't mean the whole income is going to be taxed, the new tax bracket. It's just that last dollar that you earn for the year. What is that going to be taxed at? So the first set is taxed here, next set here, next set here. So you do cross this threshold, but it's the last dollar earned that crosses these thresholds. It's not the whole tax bracket that changes. Yep.
Less of a threshing, huh, Neil?
Yeah, less of a thrashing. Yep. All right. So here we're going to go into a little bit on the standard deduction. The standard deduction keeps coming up and up and up. You know, it used to be that a lot of people would itemize their deductions. but as the standard deduction keeps going up again and again, we see that fewer people are itemizing and more people are just taking the standard deduction. So for married filing jointly, the standard deduction is now 27,700, single filer 13,850, head of household 20,800. There are some additional deductions, standard deductions you can get if you're blind over 65. There's also the child tax credit you can see here. And then the gifting or estate exclusion and credits, this did go up. So the gift or gifting exclusion annually, this does apply to some of our clients. Like if they're going to try to help a kid get into their first home, they can now gift up to 17,000. So each year we see that go up a little bit. So this year it's 17,000. How that can work is sometimes people will want to get people down payment for their first home. We all know now, homes are quite expensive, so they can gift 17,000 to their kid and to their son or daughter-in-law, and get quite a bit gifted for that down payment.
Yeah, if I may, that's 17,000 per person, per year. And if you're a married couple, that means that each one of you can give them up to $17,000 without having to file any additional paperwork with the IRS. So there's a lot of flexibility, and it can be a great estate planning tool as well.
Right. Yeah, we don't have many clients whose estates are above the 12,920,000 range, but we see those gifts in that estate exclusion also rise a little bit. GST stands for Generation Skipping Trusts. So something that applies to some folks, but we call those first world problems, where you've got this wonderful problem of having a phenomenal estate.
And the opportunity to be able to watch your heirs be able to enjoy some of your gifting.
Yep. John, you want to take this one?
Yeah, I'd love to. So this slide discusses education credits, deductions, and distributions. The two that I'm going to point out are the two most common that we recommend to clients. Oftentimes, people will be trying to fund their children or grandchildren's college education, and we often recommend that they do that through a 529 plan. So if you see down here at the bottom of the graph, 529 plans are eligible for K through 12 expenses, but only up to $10,000 per year. So that's the maximum distribution there. And there's no income phase outs with 529 plans. Higher education, the maximum distribution, well, there's none, but it's limited to the amount of qualified expenses. And so I have a list of qualified expenses here that you could use those funds for with 529 plans. They include tuition and fees, textbooks, computers and tech-related equipment, room and board payments. This also includes if you were to rent an apartment off campus, as long as the cost of that apartment was less than what you would pay on campus. 529 plans can cover that as well. The lifetime learning credit, as long as you're under $160,000 joint, $80,000 for all others, you can get a credit of up to $2,000 annually, and that's for any eligible college or university degree program, or for example, continuing education courses that would improve job skills.
John, are the qualified expenses, are they the same for K through 12 as they are for college?
I don't know if I'd let my 9-year-old move out yet. So not exactly the same. That's a good question. I think it's just for the tuition. Honestly, I'm not 100% sure though, Robert.
Good answer.
Yeah, one thing, 529 plans for sure apply to just about every one of our clients, whether or not they're making, grandchild contributions or they're making contributions for their own kids. And with the change of being able to use a 529 plan for K through 12, which was relatively recent, that was back in roughly 2019, a lot of these other vehicles lost their attractiveness. So the 529 plan has become kind of the go-to for education saving generally. I want to skip ahead and talk about one thing with the Secure Act. You guys, I know you saw this coming, but the Secure Act that was just passed, so this is the 300 pages of this huge omnibus bill, changed something specifically with 529 plans that is unique. So they're allowing a 529 plan that's not used for education. This is for somebody who, worked, they saved, they paid for their education, maybe they had some scholarships, and so most of their education was paid for through work and savings, and they didn't use their whole 529 plan. The most recent act, Secure 2.0, changed it so you can convert. I guess it would be technically a recharacterization contribution to a Roth IRA. So that's a big deal. Being able to go from 529 plan to Roth IRA is a big deal. Let's see. The couple things there. The account has to be opened for 15 years. So that's a restriction on being able to convert. So the 15-year limit. If it's less than that, they're not going to allow you to convert over to a Roth IRA. And then they're restricting the amount that can be converted each year to the participant's annual contribution amount. So right now that'd be $6,500 for somebody under 50, up to a maximum, I believe. John, isn't it 35,000?
Yep,
right.
That's it.
Yep.
Yeah, Neil, we have an interesting question from one of our attendees here.
Okay, yeah.
You can open 529 plans for yourself. I believe that's correct, right?
Yeah, you can.
If
Yes.
you were to do so, can I contribute money today, get the credit, and then immediately spend those funds for educational expenses?
Yes, you can. Yeah, you can do that. Yep. You have to cross certain thresholds. Different states are different, so it depends on if you're in Idaho or you're in another state. In the state of Oregon, you have to cross a threshold to get the state tax credit. But they also allow certain deductibility of your tuition costs anyway. So it's kind of a, if somebody had a large education expense, that could be a strategy. Get the deduction for some of your tuition expenses, get the state tax credit, and then pull the money right back out. It used to be much more common that people would do that even through college. They'd be making a contribution and pulling it out. But because of some of the deductibility of tuition, we see that happen less and less. So anything else to add to that, guys?
As far as investing the monies, we wouldn't recommend immediately
Sure.
pulling the monies out. If it's something that's intended for immediate expenditures, that's better coming from cash. But if you're looking for the modest state tax credit, then it is a technique that could work.
Great.
All right, I'll cover this one too, Neil. Tax deadlines, a lot of quarterly deadlines, which don't necessarily apply to everyone, but two big dates here. April 18th this year is the tax filing deadline. I believe that's because April 15th, the date we're used to, lies on a Saturday this year. And then you can request an extension all the way up to October 16th. Yep.
One thing I should talk a little bit about this. You can make IRA contributions up to the April 18th deadline. That's for the prior year. If you haven't earned income, you can make that 2022 contribution still to April 18th. One thing that changed with the Secure 1.0 is that they allowed the ability to make SEP or a few other type of retirement plans contributions to your extension date. So that was unique. So just to note that those are your deadlines too for contributions for 2022. Retirement plan contributions. So this definitely applies to every one of our clients, especially the savers. I should say more of those that are in their accumulation phase of wealth building. And so this makes a big difference. And it's something that part of the driver for us doing this presentation was to make sure that people knew that this changed So if they had a systematic savings, either on their employer plan or their IRA, etc., that they're systematizing that to max it out for the year, because it's really common for a year to go by like that, and then you realize, hey, you know what, I could have contributed another $2,000, $3,000, $4,000, $5,000 to my employer plan, and I missed out on it because I didn't get it done in the time frame that was allotted. So these are the new employer plan numbers that have gone up. So most of the ones that we deal with, the defined contribution plans, these are the ones that most of us know, 401k, 403b, 457, etc. There's a maximum on that. If you're using your full income, you got your matching and profit sharing on top of that. This is the maximum that you can get into a defined benefit plan, or defined contribution plan. Defined benefit plan basic limit also went up. 401k, 403b, these are our most common for most of our clients. For Roth 401k, this is the number that went up. So it seems like not too long ago it was in the teens, and 2022 we entered into the 20,000. I think it was 20,500, and now it's 22,500. That's for every employee. Doesn't matter your age. So employee can save now 22,500 of their income, no matter what their income level is. So they've, if they made 50,000 that year, they can contribute up to 22,500. And then there's a catch-up provision if you're over 50. This amount also went up 7,500 now. So you can get these two combined, $30,000 a year if you're over 50 and an employee, into your 401k, 403b, etc. Simple IRA plans also went up. So it's been kind of a slow rise, and their Secure 2.0 may increase that further, but simple IRA plan contributions, we have a number of small employers that have simple IRAs. Their contribution limits also went up. And then their catch-up contribution went up as well. So IRA, Robert, go ahead.
Yep, I think Neil, you covered most of this in the employer-sponsored plans. Just like the employer plans, the individual plans have gone up. Last year's maximum contributions to IRAs was $6,000. Now the base maximum is $6,500, so that's an extra $500 each year that anybody who has a qualifying income can contribute to an IRA. Catch up is still $1,000 for anybody, an additional $1,000 for anybody over age 50 this year. So if your 50th birthday is sometime in 2023 or before, you can now contribute $7,500 this year if you have a qualifying income. The income limits have gone up as well. Most of our clients, if they're qualifying for doing an IRA, they usually put it into a Roth IRA. The income limits last year it was 204,000 to 214,000 was the phase out range. Anybody with income below that was able to make a Roth contribution last year. They've moved those thresholds up this year, so you can make a maximum contribution if your income is somewhere between $7,500 and $218,000. As has been the case in the past, there's no limits on Roth conversions. That takes us back to the first sheet we were looking at and working on maximizing tax brackets and looking at other thresholds, but there are no limits for being able to do Roth conversions from an existing IRA or existing employer-sponsored plan.
Excellent. Health savings accounts.
Yeah, I got this one too. So HSA, not to be confused with an FSA, which stands for flexible spending account. These are health savings accounts. And we recommend these to clients all the time. They're really a great vehicle for saving. Comes out pre-tax, gross tax-free, tax-free withdrawal. Just a really great vehicle. So what you can see here, though, are the maximum deductible contributions. So let's see here. You can contribute up to $77.50 for a family, and that'll pay up to $15,000 annually. When you get an HSA, you have to have a high deductible HSA qualified healthcare plan, and that column on the right hand shows the amount that deductible has to be. That's the minimum deductible in order to open an HSA. I kind of rambled a little bit there. You want to clarify anything that I might have?
No, you hit it. Yeah, I mean, HSAs are tremendously effective for saving for health-related expenses, and so we recommend them all the time. The limit last year, I think, was around 7,300. Am I right, guys? Yeah.
Yep.
So for it to go to 77.50, this is one of the things you have to manually change a lot of times. It's not a percentage of income, but it's a figure that you have to hit, or you don't have to hit, but we recommend hitting it because it's one of these unique buckets where you get a deduction going in, tax deferred growth, tax-free liquidation, kind of get the trifecta of tax efficiency with an HSA. So if somebody can max this out for their family plan or individual plan, tremendous planning opportunity.
Yeah,
Robert,
you have all the benefits of a Roth IRA, basically, with the flexibility of being able to pull it out immediately if you have medical needs. So the HSA accounts offer some of the best flexibility and best opportunities available. Two things that I wanted to highlight real quick on differences between this and some of the retirement plans that a lot of people are more familiar with. That $77.50 or $38.50 for the maximum contributions, those are including the employer matches. If an employer is making any contributions to it as well, that limit is not what you can defer, but what is the total between your own contributions and your employer. So that's an important little piece to be aware of. And then retirement plans, the catch-up age is 50 or above. For HSAs, that extra catch-up starts at age 55. So a couple little quirks to be aware of.
Another great question from the attendees here. Can you use HSA money to pay insurance premiums?
Yeah, you can. In fact, it's a good strategy to use your HSA as like a saving vehicle. If somebody's going to retire early, they can use it to pay their health. It has to be a qualifying type of plan. You can even use it for paying for long-term care, but it has to be a qualifying long-term care plan. So it is efficient. If somebody's going to retire early before Medicare age, it's a strategy to save into an HSA to help pay for those insurance premiums up till Medicare age, which might be a good segue here to talk a little bit about the Medicare deductibles for Part B, Part A inpatient service, Part A deductible for the 61 to 90 days of hospitalization, and then after the 90 days, these numbers adjust a little bit too. So good question. Any other questions there? Anything you want to add to that, John or Robert?
Not at the moment.
I think that does it for the moment.
Social Security. So Social Security went up this year, I should say, by 8.7%. So that's a big increase. That's across the board. But there's other numbers that went up too. So maximum benefit went up. The amount that they're taxing now, if you're still paying into Social Security, they increased the number on how much income they're going to tax for Social Security. It's around like 162 now. But your max benefit went up. Retirement earnings exemption amount. So what does that apply to? From 62 to 67, typically, you have what's called an earnings test. And so it used to be last year 19,500. Now it's 21,240, which is actually a pretty significant increase as a proportion to the increase. But what does that mean? It means that you can earn up to $21,240 and not have it affect Social Security at all. If you earn above that, it's a reduction, again, between 62 to 67. That's the only age range this applies to for most clients.
It goes away after full retirement age.
Yep, after full retirement age, no more earnings test. But you can earn a little bit more now. So we do have some clients that are earning up to a certain limit so they can take Social Security and work a little bit on the side. But that's the earnings test limit now between the 62 roughly to 67. If somebody takes Social Security prior or during their full retirement year, their full retirement age year, those numbers also went up too. So you used to be a little bit less. Now, if you take it in your FRA year, you can earn up to 56,250. And then there's obviously no limit after your full retirement account age or full retirement age. So you can earn as much as you want and still get full Social Security. The tax on Social Security benefits, so the income brackets on how much Social Security is taxed, also shows here. So we do have clients this would apply to. Sorry for flipping back and forth there. Got a little roller on my mouse I hit sometimes. So, but this is related to provisional income. So provisional income is that adjusted gross income, not including Social Security, plus any tax exempt interest income that would be like from municipal bonds or things like that, plus 50% of the Social Security benefit added back in. And that's how they define provisional income. So depending on where somebody's provisional income was for married filing jointly or single head of household, this shows here what the tax is on that Social Security benefit.
Daniel, just real quick, we have a couple attendees that might have missed the introduction. A lot of numbers here. If you're interested in seeing a cheat sheet, shoot us an email. We're anonymous in the attendees group. So yeah, shoot us an email and we'll send that out to you tomorrow.
Yeah, all these numbers will be in that. Yep. All right. So Social Security thresholds for those who are still working. You know, we can't control this, but for those that are still making contributions, I mentioned that they're now going to be taxing a little more income. So wages up to 160, 200, up from 147 last year. So yeah, you're going to be paying, you're going to be paying a little bit more into Social Security if you're a higher income earner. So.
And that allows for a slightly higher benefit, increasing the benefit as well.
That's right. Yep. Medicare premium thresholds, Robert. This is a
fun one. Yeah. This definitely goes back to the thrashing part.
Absolutely. Yeah. Yeah, that's absolutely true. Because if we cross this by $1, you're thrashing, you're beating, you're stomping, suddenly goes up. So yeah.
Yeah. So Medicare premium thresholds as a whole, it's a painful piece, but there's some good news and some bad news. The good news is that the IRS is actually reducing the Part B premiums altogether. They've reduced the Part B premiums, and the Part D is right on par with where it was last year. Part B has actually gone down, and the income thresholds have been increased. So Part A is the Part A premium is what it is, period. Everybody pays Part A's premium. For higher earners, you get tacked on a surcharge in the Part B and Part D premiums if you cross some thresholds. Now, Neil, if you go to the next slide, we can actually take a look at how those numbers, what the impact of that can be and how they compare with last year. So the numbers, the income has actually gone up. You get more leeway before the premiums begin. It's looking at your modified adjusted gross income here. So this is before any tax deductions take place. This puts back into your income any tax exempt income, any tax exempt interest or dividends that you receive. All of that gets tacked back into your modified gross adjusted income. And so this year, 97,000 for individuals, 194,000 for married filing jointly. Trick on this is that is based on the numbers that you earned 2 years ago. So in 2023, the Medicare premium thresholds are being based on your modified adjusted gross income from 2021. It's a bit tricky, but that's what these numbers are, what the premiums are this year. The significance for moving forward is we use these numbers to project what your the Medicare premium threshold might be 2 years from now. So if you're approaching Medicare age or you're in Medicare age, if you're age 63 this year and in 2 years you're going to be 65 and qualifying for Medicare, these numbers matter. So, if this is your ordinary income and you're getting generous pensions and you have normal income that's in this area, then it is what it is, and we work with that. If you have, one-time events happening like capital gains from property you're selling or investment assets that we're harvesting gains on, doing Roth conversions, areas where we're able to control the flow of income. This is where it's very important to be mindful so that don't inadvertently cross a threshold that's going to impact your Medicare premiums 2 years from now. Because looking at the chart, if you're $1 over that threshold, you get kicked into that higher bucket, and the numbers on the right indicate what that could be for the impact of that over the course of the year, especially for a married couple filing jointly. That $1 can have over the threshold can have a couple $1,000 impact on your premiums.
That's right. Yep. Thanks for that, Robert. And how that applies to a lot of our clients, one of the takeaways from this is that, if you're in that 63 age to now 73 prior to RMD, if we're doing Roth conversions, this becomes kind of a number that we don't want to cross if we're going to do a Roth conversion. Mm-hmm. And like Robert mentioned, your income this year is going to be, it's going to be used for the 2025 calculation for Medicare premium, but it's unlikely that we should see these thresholds come down. It's more likely that we see them come up. But if we come up to, let's say that we're converting some amount of a Roth IRA up to the Medicare premium threshold in that 22 to 24 federal bracket, if we stay below 194, we're kind of in the safe zone for not crossing a Medicare premium threshold and adding an additional tax.
Yep.
Yeah. So, talking again here, these are some of the takeaways from this. So, major takeaways for our savers are: make sure you check your contribution limits. That's point 3 here. Make sure that you're getting the max into your HSA, your 403B, 401k. If you're doing that on a fixed monthly amount, make sure that you've changed those to max out and to get the maximum deductibility or contribution limit into your IRA, HSA, 401k, 403B, etc. Now, these are substantial increases in these brackets, but one thing I have down here is I wouldn't rush into doing a conversion, et cetera, right away, because with the cost of living adjustment to Social Security, 8.7%, you might wait a little while to see how your income ends up, playing out. A lot of times we'll do these conversions in the September, October, November timeframe when we have a clear picture of what the income, the AGI income is going to be before we do the Roth conversion. So, make sure you know what your income is going to be. Other pension type benefits, if you're on PERS, that's the Oregon employee pension plan. That also has a little bit of a cost of living adjustment too, of around 2%. So take that into consideration, because just as these brackets went up with inflation, your income may also have gone up with inflation as well. Yeah, Robert mentioned some of these things early on in the brackets, but maxing out your 12% bracket, since that number went up with long-term capital gains as well. Make sure we're maxing those out. Robert mentioned the Medicare premium threshold for Roth IRA conversions. We talked a little bit about that. Maxing out Roth, your 401k, 403b contributions. Roth IRA income limits. This is a big one. This applies to a lot of our clients that are continuing to make Roth contributions. And that's just a number that we always have in the back of our mind on whether or not somebody can do a Roth contribution or not. So again, that's around the 218 where the phase out begins.
There's a lot of tax planning that can be done around those tax brackets and tax deferred versus after tax contributions. The correlations between employer sponsored plans and individual retirement plans. A lot of planning can go into that.
Real quick question from the audience here, Neil, about HSAs again. In an HSA, how much risk is assumed, if any? I know you can invest within an HSA. You want to speak to that?
Yeah, sure. Let me go back to the HSA slide here so we have that up. So an HSA, a lot of times you can invest inside the HSA, but you don't have to. A lot of times the default is just to stay as cash. So you could be aggressive. It depends on the type of HSA account that you've opened. There's a lot to go into there, but briefly, if your health insurance offers an HSA qualifying plan, a lot of times they're tied together. So your HSA and the investments inside the HSA are going to be dependent upon the menu that they offer, if they offer any at all. If you have more flexibility to go and open your own HSA outside of a lumped together HSA qualifying plan, you have a lot more flexibility on what investments are offered there. But a lot of times the default, we have clients where we're helping them make sure that they're invested inside their HSA. And our recommendation there tends to be keep your deductible in cash, because you might use that throughout the year, and then invest the difference. Several of the clients that we have that work here that have HSAs, there's an HSA oriented investment account, which is kind of maybe a little bit on the conservative side of a balanced investment allocation. So if that gives some idea there, a little bit on the conservative side of balance is a good target that's practical for most investors inside an HSA. However, I'll say this, that you can, if you're using your HSA like a Roth IRA, so you're paying your health expenses out of pocket and letting this HSA grow like a Roth, we would recommend being aggressive and growing that account as aggressively as you can. Anything else there? How'd I do, guys? Any questions on that?
Kind of good, Neil.
All right, let's jump into, let's jump into Secure 2.0. So we've got maybe another 6 minutes. So I'm going to blast through some of these changes that just happened in the last couple months with the Secure Act and the Omnibus bill being passed. So
Couple months. This has all happened in the last couple weeks, Neil.
yeah, it's true. Yeah. What was it? December 19th, I think it is. So we're coming up
Yeah.
on the 1 month anniversary right now of the Secure 2.0. So this changed the
4,000
number.
pages.
Yep. 4,000 pages, about 300 applied to our industry. Two main things that changed, and this changed this year, is that they kicked out the RMD age to 73, and they're going to phase it into 75. So this applies to a lot of our late 60-year-olds too, in that they have a little longer time to do their conversions if they're converting out of a deferred account into a Roth IRA account. So this absolutely everything here with the tax bracket changes and the Medicare premium thresholds for those folks, it's a big deal that they're kicking it out to 75. Now, if you turn 62 in January of this year and you barely scraped out of the 72 from 2022, your RMD then wouldn't be due until April 1st of 2025. So it really
There would
pushed
be.
out. Yeah.
Yeah, sorry, Neil. Yeah, as Neil was saying, if you turned 72 on December 31st of 2022, you have a 2022 RMD that you're responsible for. If you turn 72 on January 1st of 2023, then you have no RMD this year, and your RMDs start next year in 2024. And as Neil was saying, for the first year of RMDs only, you have the option of pushing that first year RMD out to your second year. So in 2025, if you would be responsible for your 2024 RMD and your 2025 RMD in that year. But that's only if you're turning 72 this year and you turn 73 next year.
Yeah. But not all of the Secure Act actually applied to 2023. That's important to know. So as you see on our slide here, a lot of the IRA catch-up contribution is going to begin to index with inflation. So it's going to be something that you're going to need to, and that we'll make sure we keep people posted on how much that's going to increase each year. That doesn't start though till 2024. Other things like greater 401k catch-up contributions, they're going to add a specific, like a super catch-up contribution from ages 60 to 63. That's going to be great. That doesn't start till 2025. Yeah. And then I believe they're going to require it to be Roth if you're over certain income limits as well. So there's going to be a lot that starts coming out on the Secure 2.0 Act. Many things don't apply to this particular year. Yeah, that's this year. Catch-up contributions for high earners over 145,000 that are indexed for inflation must be Roth starting in 2024. We call it the Rothification. Other changes, these are some significant things that are changing. Again, not in this year, but something to keep in mind. ABLE accounts, which are a type of disability account, kind of like a special needs trust account. You used to have to be disabled prior to 26 years old. And so they kicked that out to 46, which I think is just a great thing. I'm really glad that they did that. Now easier to put annuities in retirement plans. It's questionable whether or not that's a good thing for folks. QCD limits are now indexed for inflation. It used to be a flat $100,000, but now they're going to index that QCD limit upwards. There's going to be a national database for lost or forgotten retirement accounts, and I can't tell you how many times we've had clients say, "Hey, I got this statement in the mail that I had this small pension account from 20, 30, 40 years ago," and so they're going to start making a national database for these lost or forgotten retirement accounts. They're going to add a savers credit to low income or low earners. I don't know how they're going to do this. This is out in 2027, so it doesn't apply to a lot of our clients, but in 2027, the government's going to start making a matching contribution for lower income savers. And yes, there's more. Auto enrollment for retirement plans at 10%. We're big fans of 15% saved, so it's going to start at 10 and then index up to 15. SEP and simple IRA contributions as Roth. This is a significant thing.
Oh yeah.
Something to keep in mind because they haven't allowed SEP or simple to be Roth contributions. So we had to go to the Roth 401k, but now they're going to offer that as a SEP or simple. They're adding in a number of different withdrawal. What do I want to say here? You know, you have a withdrawal penalty prior to 59.5 or 55 in some cases. So they're adding a number of different
Exclusions.
exclusions from the penalty. That's right. Yep. But again, most of these things don't come into play until 2024 or after. The main one is this RMD age that definitely applies to all of our clients, and kicking that out. The actionable item from that is if you have been doing conversions to try to reduce what that RMD will be and stay within those tax brackets or Medicare premium thresholds, that you have longer to do that. And that's a big benefit.
Yeah. And you know, there are hundreds of pages of Secure Act 2.0. There's a lot of weeds we can go into. This is a very high level skimming the surface of what some of the highlights of it are.
Yep. Yeah, from my perspective, the two big things that apply to most of our clients, RMD is going to be a big one, and that ability to convert, or I'm calling it recharacterize as contribution, a 529 plan into a Roth IRA. Definitely that, because we have the conversation all the time. Should we do 529 plan or should we do a UTMA account? You know, a lot of times it's kind of, you know, where do we go? Well, if you could convert a 529 plan, if they don't use it, because that's the question, what if they don't use the 529 plan? If you could convert that into a Roth, it just makes it that much more attractive.
I love the options that it opens up.
Absolutely. Yep.
And then also I'm excited about the employer contribution, the catch-up 2.0 coming up in the future.
Yeah.
That's going to be a big boost for those who are getting close to retirement and trying to load up as much as possible.
Absolutely. Yeah, I mean, it's common. We see it all the time where, you know, people finally hit their income stride, you know, in that later years. So being able to kind of finally fill that bucket, you know, when they're in their later years, is a wonderful opportunity. I'm really glad that they added that in. It seems strange that they'd limit our ability to save at all, but you know, yep, it's good that they're adding that super catch-up contribution after 60.
Yeah.
So here we are, guys, 5:52. Let's take a few questions, and we'll try to answer those and then wrap it up.
Yeah. In the meantime, if there's while we're waiting for any last minute questions to come in, a couple other items in Secure 2.0 that popped up, some Roth changes that are taking place now, allowing for employer contributions to go in as Roth.
That's right. Yep.
That's an interesting one. I'm not entirely sure how that's going to work, and I'm not entirely sure what the tax consequences of that are going to be, but it's an exciting new option to have.
Yeah, we do know that they're going to tax the individual for the employer's contribution, which isn't, you know, that makes sense, but I don't know how they're going to exactly implement. Does that mean then that the amount that goes into the Roth is the after-tax amount is a matching contribution, or is it the pre-tax amount that they then take taxes out of? How do they do that exactly? I don't know if they know, but we'll see.
It's probably why it's going to be a year or two down the line before they implement it. And then from our standpoint, it's a matter of having to do some brain crunching on what that implication is going to be on tax brackets.
Yeah. We have one question.
Yeah, go for it, John.
Robert was about to say it. The question states this: would you agree that if one is taking RMD, that they should not make estimated payments, but should use their RMD and have money withheld late in the year?
Hmm.
For
So let me see
IRA income.
if I understand that right. So the question is, if they're taking RMD, if they're taking their RMD, should they make estimated payments on their RMD throughout the year or wait to the end of the year? Is that right?
That's what it states. Yep.
Yeah. So most of our clients, we have a tax withholding on the RMD on the date that it's taken. So if it's monthly, you know, we're having monthly amounts taken out throughout the year. So if we've done our job, hopefully there's no excess tax due on those dollars. But it partially depends on, you know, if you're taking it later in the year and you don't have, or you took it earlier in the year and you had no tax withholding, because it's not required on IRAs. It may be advisable to pay a quarterly estimate in that particular quarter. But for most of our clients, we have tax withholding integrated into their distribution. So hopefully,
We're getting a clarification on the question that, you know, referring to the total federal taxes for the year. You know, so if that sounds like an interesting question. You know, if having a lot of income and having to pay on a quarterly basis for what the other sources of income are, then my immediate thought would be to use the RM to withhold taxes from the R&D and treat it separately, because we don't want anybody getting penalized for late payment and having interest charged for those payments. That's the purpose of the quarterly payments. If your RMD is being pulled in the fourth quarter, then taxes for it will not be late if they're paid in Q1 of the next year when you file your taxes. But if you are receiving income from other sources earlier in the year and you don't receive your RMD until the end of the year, that might have some tax ramifications because your tax is technically late. Neil, do you want to add on?
Yeah, one thing that we have had come up is if somebody's doing a Roth conversion, you know, should they pay a quarterly estimated tax too? And yes, we do recommend paying your quarterly estimate in the month or the quarter that you take your Roth conversion, because that is also a taxable event as ordinary income. Yep. Speaking of RMD, one thing I missed on the Secure 2.0, and this is a big deal too, they're reducing, this is in 2023 too, they're reducing the penalty. So it used to be 50% excise tax, so they're lowering that down to 25. And if you catch it soon, they're lowering it to 10. From experience, if it's caught early, and you can usually get a one-time exception if you made a mistake on that. But that's a big difference, going from 50% excise tax to 25. And that's also a 2023 year for RMD. If you miss it in the calendar year. Any other questions, guys?
Touching back just to make sure that we're addressing that RMD question, I suppose that if you wanted to take your RMD in Q1 and have a large chunk withheld from that to prepay your taxes, I suppose that would be an option. But you know, when you're prepaying your taxes, that's giving the IRS a interest-free loan, which isn't necessarily the most efficient approach either. So if you have more, if you want to take that, you know, go into more detail, please give us a call. We'll be glad to you know, have a more in-depth, more personalized conversation on that.
Yep. All right. Well, here we are hour skipped right by, guys. So thank you all for participating and thank you for coming. Hopefully this has been helpful. We will for sure get our cheat sheet of all this data that we're using here sent out to everybody who participated. And again, if there's ever questions, thoughts, concerns, we want to go into a little bit more depth on something that we talked about with Secure 2.0 or how Medicare premium thresholds would work or Roth conversions or these sorts of things. Never hesitate reaching out to any one of us. We'll get you on the schedule and we'll get the question answered.
And then just a reminder, you can just reply to my email if I don't have your email address and you are anonymous here, just reply to my email and I'll get that right out to you.
Great. All right. Well, thank you, everyone. Thanks for participating.
Thank you.
Have a great evening.